Good day, fellow investors. Howard Marks writes always very interesting memos, but when it comes to really action-taking, decision-making content, he lacks that there. Let's discuss first the memo and then try to add more value if you can handle it. The last memo, the calculus of value, great memo discussing price, value, the interaction between price and value, how price is on the markets, and how the real value comes out only later. He discusses how the real value is intrinsic value based on earnings power. However, you have to compare it to the price to see whether something is a good investment or not. And that's exactly what we do in our intrinsic value template. You have this free one in the link in the description below on my free value investing course that gets updated with the stocks that we discuss on YouTube, and you also have the premium one on my research platform. The thing is that with the price, you know the price. Rationality would say that it discounts all the future cash flows that one expects to get from a business, the real value. However, reality is that it is based on people's subjective opinions about whatever pushes demand and supply of that business, stocks, bonds, whatever, up or down. For example, this was a great comment. I'm levered long on Lulu going into earnings. We'll see what happens. Well, we'll see what happens is not the way to invest, but we'll see what happens is something that greatly explains this stock market. And an asset's price is not based on its fundamentals, it's based on the consensus view that the broad market population has. And there can be always optimists, optimistic view, pessimistic view. Just look at Amazon. Just 3 years ago, the stock price was 84, now we are 225. So there are these positive, negative, longer term cycles, but even if you look into just 1 year, we are now 225, we were at 240, then we were down in 160, 30% down, up then again. That is the crazy situations on market that really shows that it's not about long-term business, but more about short-term opinions. And with those short-term opinions, the key is that good returns depend on price paid, first and foremost. Short-term prices, even if you buy some value, it can become even better value because short-term prices can go anywhere, but over the long term, fundamentals should follow. And that is also discussed by Marx. In the short term, the market is a voting machine. In the long term, it is a weighing machine based on fundamentals, as Benjamin Graham said. Now, what conditions might give rise to the superior risk-adjusted returns active investors crave? If you're watching this video, you want superior returns, is what we want on this channel. Well, first you have the asset's current value. The market price must be lower than your estimated value. Then that has to increase more than investors anticipated. And then the stock price goes higher, you have a change in value or a change in fundamentals, and you are rewarded. However, if there is no such thing, you cannot get superior returns. And that's exactly what Marx discusses about the market. At current levels, there is nothing that gives you an advantage with the stock market or general bonds. Therefore, it might be better not to be invested. And he says, what can we say about the price value calculus today? Not much good. It is clear that we are in a level of exuberance and that high valuations are all over the place. All kind of things fire investor imaginations that contribute to bull markets. And that's what we have now, but we cannot predict what will be the future. And the existence of overvaluation can never be proved. We cannot know whether markets will crash, whether markets are overvalued or not. However, here Marx goes into, okay, what can we do? We can stop buying, we can reduce aggressive holdings, sell off remaining aggressive holdings, and then If we are certain about the crash, we can trim defensive holdings, eliminate all holdings, thus go into cash like Buffett has done, and then the last resort is to go short. What does Marx say? Well, he says to reduce aggressive holdings and increase defensive holdings and stop buying. And that's it. Here he stops. Why? Because, of course, he can't predict. He has always been a bond investor, so high-yield bonds, 7% performance over the last 30-40 years, that is Howard Marks. Nothing more, nothing less, but yes, he nailed the dot-com bubble with his Memo, became famous, and he is available to media outlets to discuss. However, he is making a nice story. And now we come to the difficult part, as he also shares. He cannot tell you what to do. You can go into bonds, high-yield bonds, 6.5% yield, possibly, I don't know, 8% of those go bankrupt. So you can have a 6% yield over the long term, minus 3% inflation or more. And that is 3%. I'm sure you are not here for such a return. Even if you look at the high-yield corporate bond ETF, you can see here that it is mostly dividend and real values decline over time. Of course, it was a great buy here when yields were 20%, and then also those that bought here made money on the positive. However, now at a 6% average, some of those go bankrupt. It's not that you will make much more money. Thus, not buying, current yield 1.2% S&P 500, don't buy that. We have discussed some value. For example, oil companies in Norway, very low cost, give you a 9% yield, which is already something. So that's, let's say, the defensive situation there. But in general, it's very hard to find great investments now. This is the value investing quadrant. 2 extras are there if you watch the video that I made 2 days ago. The thing is that with such situations, with such low yields, with the stock market being at 10x over the last 15 years, we must lower our return expectations. That is a given. Here and here. So when there is disasters, there's real blood on the markets, then you can invest for high returns. But now there is nothing new in Marx's discussion. All these, let's say, gurus have been saying that we are in a bubble. The bubble continues, and that is, as they also say, unpredictable. However, the key factor you need to make the decision is, how are you going to deal with it? It is impossible to predict whether the bubble will burst or not. If you go into cash now, we have higher inflation over the next 5 years, you end up 50% purchasing power down if you go into cash, if you sell everything. If you stay into stocks, maybe even 50% down. So the solution, in my opinion, is always fundamentals. And here I want to warn about something. I've taken 2-month break on YouTube, and you can see here no videos here. Now we are back, and I must say something that it just gives you peace of mind, because YouTube is more gambling than others. So be very careful when it comes to YouTube. Perhaps, yes, as Mark says, we have to be patient. Oh, if you're looking at how rich am I getting here on YouTube, if you go to my page, you go to charity, everything is donated. We are refurbishing 3 schools in Nepal this year. I still have to add the local school donation, and that's the $28,000 minus taxes. So it's all donated, don't worry. And then I look at the comments that people ask, can you do Novo, United Health? The majority on YouTube try to make the quick buck. Stocks go up, this and that is a very, very dangerous, exuberant also factor that Howard Marks mentions. Can we predict? No. If you want true value, you can check my research platform and the last YouTube quadrant video discussing more investments from a fundamental perspective. If you want more, even in this environment, you need to go away from standard market investments, you need to go away even from high yield investments, as Mark says, and you need to really go in specific things. That is unfortunately how it is. So, very nice memo from Marx, not predicting anything, just warning you that you check your risk and reward, what you can risk, what you can't risk, and adjust accordingly. And if you have to accept lower returns, that's also something to think about.